A major structural disruption has just materialized at the intersection of United States trade policy, global supply chains, and international commodities markets. The United States Supreme Court recently struck down broad global tariffs originally implemented under the International Emergency Economic Powers Act. In immediate response, a new executive order was signed imposing a 10% global tariff, which was swiftly escalated to 15%. Simultaneously, a severe lag in the United States Customs and Border Protection software systems has forced importers to continue paying the legally invalidated duties. Over a single weekend, an estimated 211,000 containers of goods, valued at roughly $8.2 billion, arrived at United States ports and became immediately subject to this administrative friction. In the exact same week, the global physical silver market experienced historic upward volatility, with spot prices closing at $84.52 per ounce, representing a near 9% weekly gain. This occurred entirely without the participation of Chinese markets, which were closed for the Lunar New Year. We are witnessing a collision between shifting sovereign trade posturing and a severe repricing of finite industrial assets. The structural question for long-term capital allocators is whether surface-level trade policies are merely masking a much deeper mathematical reality regarding sovereign debt and the permanent revaluation of hard assets. The primary lens through which this macroeconomic shift transmits to the domestic economy is the direct impact on United States households, operating through highly specific transmission channels. The immediate reinstatement of a 15% global tariff structure creates a direct and unavoidable inflationary pressure on consumer goods. This is not a theoretical cost, it is a mathematical pass-through. Furthermore, the $8.2 billion in goods temporarily trapped by the outdated Customs and Border Protection tariff collection system introduces acute short-term supply chain friction. Retailers and distributors operating on tight margins do not absorb these administrative and capital costs. They transfer them to the end consumer, elevating the baseline cost of living. Beyond the immediate trade frictions, a more systemic mechanism is actively eroding consumer purchasing power. The United States national debt has crossed $36 trillion, creating a debt-to-gross domestic product ratio of approximately 124%. The annual interest expense required simply to service this debt has reached $1.2 trillion. Sustaining this level of sovereign obligation functionally requires continuous monetary expansion. As the monetary base expands to monetize this debt, the purchasing power of the wages earned by the American workforce is inherently and systematically diluted. Furthermore, the structural repricing of industrial commodities, specifically the surge in silver prices, establishes a permanently higher baseline cost for essential future-facing consumer goods. Because silver is a highly conductive, non-substitutable input in electric vehicles, solar arrays, and advanced electronics, households will face structurally higher prices for green technology and consumer electronics, further straining domestic financial stability. Beneath the household level, United States industries are experiencing a severe reallocation of capital and acute margin compression. The import and logistics sectors are currently navigating an immediate cash flow trap. Importers face a strict 10-day window to pay the Customs and Border Protection Agency for the legally invalidated tariffs in order to secure the release of their physical goods. These logistics firms must post billions of dollars in payments and then rely on the United States Court of International Trade for post-summary corrections and refunds. Due to the unprecedented volume of these claims, this refund process could take weeks or potentially years, locking up vital operating capital and fundamentally altering trade balance velocity. Simultaneously, the high technology and green manufacturing sectors are facing an input cost crisis. Silver demand within the solar, electric vehicle, and artificial intelligence hardware sectors is functionally inelastic. At current technological efficiency levels, substitutes for silver paste in solar panels or silver interconnects in advanced semiconductors are simply not commercially viable. Consequently, original equipment manufacturers are forced to absorb soaring input costs as silver stabilizes well above $84 per ounce. These manufacturers cannot easily pass a 100% increase in raw material cost to the consumer without destroying demand, which guarantees severe margin compression across the entire domestic green energy and technology manufacturing base. In the financial sector, bullion banks are facing their own structural constraints. The implementation of Basel IV regulations, specifically the net stable funding ratio requirements, has aggressively increased the carrying cost of unallocated paper precious metal positions. The traditional mechanism of using massive unallocated paper shorts to manage commodity volatility is becoming prohibitively expensive for Western financial institutions, forcing a shift in how industrial capital is allocated and protected. Shifting the analytical lens to the global manufacturing base, China presents a complex matrix of deep industrial leverage combined with acute structural vulnerabilities. From a positioning standpoint, China dominates the global manufacturing pipeline for both solar panels and electric vehicles. This dominance structurally embeds a massive, inelastic demand for physical silver into the core of the Chinese industrial strategy. However, this required leverage exposes a critical structural vulnerability. Chinese industrial operations are currently facing a severe physical silver shortage. The combined silver bullion inventories at the Shanghai Gold Exchange and the Shanghai Futures Exchange have declined to documented decade lows. The severity of this shortage was highlighted just before the Lunar New Year holiday, when major recyclers based in Shenzhen were forced to bid $93 per ounce for physical silver in order to secure supply. This represented a significant multi-dollar premium over the prevailing Western spot prices, indicating that internal industrial demand has completely overwhelmed available exchange inventories. Simultaneously, China is executing a long-term strategic currency maneuver. The Chinese yuan has recently demonstrated strength against the United States dollar, momentarily increasing the purchasing power of Chinese institutions acquiring dollar-denominated global assets. Concurrently, the Chinese sovereign wealth apparatus is engaging in a massive accumulation of physical gold. While official numbers cite roughly 2,300 metric tons, institutional analysts estimate the true sovereign holdings to be multiple times higher. This systematic accumulation of hard assets is a deliberate structural hedge designed to reduce the nation's reliance on the United States dollar system and protect its industrial base from Western financial leverage. These structural shifts in global commodities also deeply implicate India, which has emerged as a primary demand engine for physical assets. India recently absorbed approximately 45 million ounces of physical silver from the global market in a single month. This unprecedented volume of physical asset accumulation represents a deliberate sovereign and institutional strategy to secure critical supply chains and hedge against fiat currency devaluation ahead of Western industrial consumers. However, when analyzing the distribution of this economic maneuvering, it is critical to recognize the structural constraints within the Indian domestic economy. This aggressive absorption of physical wealth at the institutional and sovereign level does not automatically translate to widespread income growth or prosperity for lower income groups. The transmission of this wealth preservation strategy remains highly concentrated. While the Indian state secures its macroeconomic baseline against global volatility, the domestic inequality implications remain profound. The capital deployed to secure tens of millions of ounces of hard assets is capital not deployed into immediate domestic infrastructure or wage expansion, highlighting the stark reality that sovereign structural security and universal household prosperity are distinct and often conflicting economic outcomes. Zooming out to the global systemic context, we are observing a fundamental decoupling between paper financial markets and physical trade flows. The most glaring evidence of this systemic shift is the divergence occurring within global commodity markets. The Commodity Exchange, or COMEX, currently holds a registered silver pool, representing metal genuinely available for physical delivery, of approximately 88.19 million ounces. In stark contrast, roughly 90 million ounces were drained from COMEX and institutional exchange-traded fund vaults in a period of just 4 weeks. Market analysts note that there are currently between 100 and 250 paper claims existing for every single physical ounce of silver available for delivery. This represents a systemic imbalance of historical proportions. Furthermore, the global trade flow implications of recent tariff policies reveal a severe mathematical inadequacy. The global tariffs initially canceled by the Supreme Court and subsequently reinstated via executive order were projected to generate roughly $1.5 trillion in revenue over a decade. This figure is mathematically insufficient to resolve structural sovereign debt imbalances when the United States is running an annual fiscal deficit approaching $2 trillion. Trade policy is proving entirely incapable of bridging the sovereign fiscal gap. In response to this mathematical reality, a broader systemic de-dollarization is accelerating. Catalyzed by geopolitical events, such as the freezing of Russian central bank reserves in 2022, the BRICS nations are systematically reducing their exposure to United States Treasury bonds. They are aggressively reallocating sovereign reserves into hard assets, such as gold and silver, which carry zero counterparty risk, fundamentally shifting the systemic balance of global trade and currency stability. As we progress deeper into this analysis, we must address the hidden structural risks and second-order effects that have the potential to escalate this market dynamic into a systemic unwinding. We recently observed a critical failure of standard market suppression mechanics. Following the Supreme Court tariff ruling, high-frequency trading algorithms executed a coordinated paper sell-off based on predefined deflationary keyword logic, driving the spot price of silver down to $77.39 in minutes. However, this algorithmic pricing model failed to hold. Sovereign wealth funds, industrial procurement managers, and physical metal dealers utilized this manufactured discount as an acquisition event. The physical buying pressure instantly absorbed the algorithmic selling, reversing the price to a close of $84.52, fundamentally trapping institutional short sellers. These institutions are now managing rapidly deteriorating positions, facing a mechanical obligation to buy back their shorts, which mathematically initiates a self-reinforcing squeeze on available supply. The most immediate hidden risk lies within the commodity exchange delivery mechanics. Currently, the open interest in prompt silver futures contracts vastly exceeds the deliverable registered supply, creating a verified mismatch of roughly 134 million ounces. If industrial hedgers and long contract holders demand physical delivery rather than rolling their contracts forward, the exchange faces an operational impossibility. The response protocol is a declared force majeure event, resulting in a forced cash settlement that would permanently decouple the physical spot price from the paper futures price. We are already seeing institutional anxiety regarding this outcome. The recent, highly irregular media tour of the Bank of England's subterranean gold vaults operated as a calculated psychological operation designed to project visual solvency and distract from the fact that the commodity exchange in New York is rapidly draining of physical inventory. Furthermore, these market mechanics are highly sensitive to geopolitical escalation. Any significant kinetic military action in the Middle East, particularly concerning the Strait of Hormuz, threatens 20% of global energy supplies. Such an event over a weekend, when Western paper markets are frozen, would trigger instantaneous margin calls upon the market open, leaving institutions holding short paper positions completely immobilized against an escalating physical price discovered by Asian markets. Projecting these structural dynamics over the next 3 to 10 years reveals a profound shift in global capital positioning. The dominant long-term factor is institutional capital migration into hard assets, driven by historical ratio compressions. Currently, the Dow Jones Industrial Average priced in ounces of gold sits at approximately 9.85, a level identical to 1973, right before the largest precious metals bull market in modern history. Institutional analysts are projecting a contraction of this ratio to 2.5, alongside a gold-to-silver ratio compression toward a historical norm of 35:1. Even under conservative mathematical modeling, this framework targets a structural silver price well above $400 per ounce by the early 2030s. The underlying catalyst for this migration is the $50 trillion held by global pension funds. These funds currently hold near 0% allocations to physical precious metals. A mere 1% rotation by these institutions into hard assets equates to $500 billion of capital, chasing a global silver mining output that is currently valued at under $100 billion annually. This represents a mathematical certainty of exponential price dislocation. The market cannot organically absorb this capital because the supply side is completely inelastic. 70% of global silver is mined strictly as a byproduct of base metals like copper, lead, and zinc. Therefore, higher silver prices do not inherently incentivize increased mining production. Even for primary silver deposits, the timeline from geological discovery to active production takes 7 to 10 years. The supply response cannot meet the impending demand wave. We have seen this exact structural setup before. In 2008, and again in 2020, systemic shock events caused the paper price of silver to collapse while the physical price decoupled, commanding significant premiums before the paper market was forced to aggressively reprice upward to meet physical reality. Over the next decade, the structural winners will be the sovereign nations and institutions that accumulated physical, counterparty-free assets before the paper leverage system broke down. The structural losers will be the industrial manufacturing entities that relied on suppressed paper prices and failed to secure physical supply chains. The United States' positioning within this shifting global balance will depend entirely on its ability to navigate an environment where the global East is no longer willing to finance Western debt, opting instead to aggressively drain the West of its critical industrial and monetary metals. The macroeconomic environment is no longer rewarding passive observation or reliance on conventional backward-looking models. Navigating the collision between sovereign debt expansion, inelastic industrial demand, and the structural decoupling of physical and paper markets requires rigorous, data-driven intelligence. Here at ETN, we prioritize consequence modeling over storytelling, stripping away the emotional framing to deliver the structural analysis that institutional capital relies on. If you require this level of disciplined, macro-level insight to guide your long-term positioning, we invite you to subscribe to the channel. Thank you for utilizing ETN for your strategic economic intelligence.